So thank you so much, gentlemen. I think what's great about our panel is we're really bringing the asset allocator perspective to impact and making it very tangible. And Ketan, I actually want to start with a paraphrase from a great interview that you did with Carsten Stedtevad, who's the co-CEO of sustainability at Bridgewater. And he said in his interview, we've seen that themes pertaining to environmental issues, social issues, governance issues are starting to affect policymaker choices, investment flows, corporate decisions, and consumer behavior. So by default, it is impacting markets. You're not just looking at return and risk, you also now need to evaluate around the third dimension of impact. So let's start there, and maybe before we dive into the first question, if you could briefly introduce yourselves for the benefit of the audience.
Sure. I'm Tarik, Serri. I'm responsible for the hedge fund and alternative investments programs at TCC. Since 2009, we've been managing successfully the Air Canada pension assets. It's the largest corporate pension in the country, and our DNA is really alternative and hedge funds. We're managing really internal and external hedge funds and private markets with a AUM of $30 billion.
Thank you. Ketan Patel. I'm the CEO of Greater Pacific Capital. We invest for profit and impact in emerging markets. Our main market is India. I'm also the chairman of something called Force for Good, which works with the United Nations on the UN Sustainable Development Goals to see if the world effectively can be leveled up. So it's an enormous and interesting challenge to see if investment flows can actually go into the EMs to see a leveling up of the world.
I'm Stergios Voskopoulos, CEO of ALTNOVEL. ALTNOVEL is an investment firm that focuses on private capital, mainly for private investors. Innovation and impact are key aspects on how we do business, how we structure investment solutions for our investors, and also how we actually invest at the end from a mindset perspective, and that relates to impact.
Excellent. So let's start with the macro picture then, and then dive down a bit deeper. Obviously, impact is affecting markets, but it's a very broad term. Concept can be interpreted in multiple ways. So I'd just like to start, and maybe we start with you, Ketan, on how do you view impact and how does this translate for you? And then we'll move on to Tarik and Stergios.
So what a difficult macro. So, we've had the pandemic, we've had the war, we've had the first war in Europe, we have a war in the Middle East. All we need now is a war in Asia, and then we can link it all together and have a world war. So it couldn't be much more complex than we're ending up in now. At the same time, every metric of impact using the UN Sustainable Development Goals is not on target. There are 17 UN Sustainable Development Goals, and none of them are on target. Half of them are either stalled or regressed. And so, we're in a situation where there are really at least two worlds. There's a world which is 1/3 of the world's population, which is doing well. And there's another world which is 2/3 of the world's population, which is not doing well. And the two seem as if they're not linked together. The poor world is always asking the rich world for money to be invested, and the rich world doesn't invest. I thought the quote you started with from Carsten was very powerful, because here's Bridgewater, the biggest hedge fund in the world, saying we don't, looking forward now, just measure risk and return. We measure risk, return, and impact. And all the impact in the world is expected predominantly to come from the south of the world, the global south. And so the largest market, 2/3 of the world population, unlocked by technology, should be the future of investing, particularly long-term investing. And that's where we see the excitement, actually. The excitement is the technology enables the global south to be unlocked. I'd love to talk about it a little bit more when we get to that part of the conversation.
Excellent. Thank you for setting the scene. And Tarik, Carsten mentioned that you now view through this third lens of impact as well. How do you see that in your portfolio?
Right, so for us, we don't have a direct impact mandate per se, but we do have an ESG integrated approach. So basically, it's really looking at all ESG factor analysis and how it integrates in our investment process. It's also important to note that we didn't have that a few years ago, so we're just building that out, right? It's just having that trend where you start with the inclusion list and then integrate the ESG process within that investment process, having your ESG team work with your investment team, and then achieve an impact mandate. And for us, that impact mandate needs to be measurable in terms of social and environmental impact, in addition to have a financial return that is really important for us. So for example, in private markets, we do have a mid-teen return target, 15 plus. So with impact, can we get that return target, for example? So it's always a constant debate. And also the main objective for us is really, it's all about data and reporting from underlying GPs, right? Every asset class is different, every GP is different. The years that went by, we really learned a lot of observations and nuances across the different GPs, the asset class, how every person explains what is ESG. Each letter means something differently for every GP. It's really fascinating how, with the new associations coming in and the mandates, learning about that and integrating within TCC at the firm level.
Excellent, and I want to dive a bit deeper into a few of those things. ESG, everyone's favorite acronym, and also the variation that you're seeing across those different asset classes within alternatives. But maybe Stergios, if you could talk about how you view impact. You mentioned it's not only on the investment side, but also like on the actual integration and technology side as well.
Yeah, I think impact is a bit abstract in general. So for us, when we look at investing in private capital, it's not a vertical, it's not an allocation, but it's a philosophy of investing. I remember before 2008, the global financial crisis, I was a risk manager back then. And we used to talk about risk-adjusted IRRs, right? And very few people would talk in the industry about risk-adjusted IRR. They would talk only about IRR. So today in 2023, I think we need to start talking more about impact-adjusted IRRs. And we do believe that financial returns and impact go together. We like to invest in companies that make an impact because from a valuation perspective, I would apply a higher multiple in a company that does good and has a more sustainable business model in the future. So from a technology perspective, we want to work more on analytics. Now, we're working on this as a firm the same way we're reporting returns and downside protection and upside potential. And we want to start applying also some impact metrics. And so as investors, we know that that's my expected IRR and that's my expected impact.
It's interesting you mentioned the risk-adjusted return, impact-adjusted return. You could potentially also argue that if you don't account for impact, it's extremely risky. Like, governance, not having good governance is very binary. Also, if you look at other things like climate risk and other issues around, that the ESG part. So to dive into that ESG acronym, they're very different. Like, Tarik, I'd like your view here on, do you separate these three when you look at it? If they don't have good governance, is it a complete no-go area for you?
Yeah, so happy to expand on that. So we do have a pre-screener, pre-investment ESG questionnaire that we send to our prospective GPs, right? So just covering ESG, there's roughly 20 questions, and it's really about, if they have a policy in place, and is it integrated? Do they have it part of the investment process? Do they have dedicated resource for ESG, for example? Do they have a climate risk policy, DEI as well? And in terms of reporting, how do you do it? So we try to put everything together and aggregate all the data. So we do focus on all three letters. In my personal view, it's equally important, but G is the baseline for us. We wouldn't invest in a manager that has bad governance, but that being said, we've done a lot of hand-holding for managers that have weaker governance processes and structures. They tend to be on the smaller scale, smaller GPs or emerging market GPs, and including ODD as well. So that's something that we worked with them just to get us to the minimum threshold. And it's been a really good collaborative approach with the GP and the LP working together and sharing our knowledge with them as well.
So that's interesting. So even if the GP didn't have frameworks in place, you would work with them to potentially get up the curve there?
It really depends on the strategy and how niche is the manager and how open is the management team to actually take our feedback as well.
Excellent. And Ketan, moving to you, you do a lot of investing in India and in other emerging markets. Perhaps talk us through how you see impact and ESG on the investment side.
Yeah, sure. So, it's highly commercial to invest in businesses that have good governance, good social impact too, and good environmental impact. And I'll explain why. So, there's a temptation to think if someone's making a social impact, they must be diverting attention from making money. We found that's absolutely not the case. So if we invest in a financial services institution in a poor country or a developing country or an emerging market that is serving the mass public, their ability to make sure the mass public that they're serving, this customer, is somebody who will prosper, is much more likely to result in them making more money. So if I take a very practical example, we invest in a financial service institution in an emerging market, I'll take India, and they give a loan to somebody poor. That somebody poor might be, usually is a woman actually, because women pay back and men don't pay back the loan, as it turns out. So you lend to a woman, the woman will be hard at work trying to pay this loan back. When will the default happen? The default will happen if somebody dies in the family. The default will happen if somebody falls ill in the family. So if you package into that loan an insurance policy, a health insurance policy for somebody falling ill, or you package in 2 or 3 defaults as part of the insurance cover, you are much more likely to get that money back. And so it's highly commercial to do so. It's a good thing to do too, and you will feel that you have achieved a purpose, but it's just very commercial to do so. So what we find is if we take 2 financial institutions, one that understands the social environment within which they're lending and examines all the risks and figures out real risk mitigation through insurance or other means, and one that thinks its job is to process bits of paper, that first one is a much more fit to invest in business. They have understood that the context they operate in has an environment in which people can default, in which people will underperform. And so risk requires a much wider lens of understanding of the environment. And so we found is that these split very well all across the world actually. So with our Force for Good hat on, we supported the analysis of 125 financial institutions in the world. These are the largest. They represent more than half the world's money. And what we found was that those that really understand impact, that go into an environment to deliver an impact alongside their lending, their insuring, their pension funds, and so on, make far more profit for shareholders over a 10-year period than those that don't. Those that have now thought their job is efficiency and effectiveness and simply processing, and might be very good at processing, are actually a different category of performer, far lower than those that actually fully understand the environment which they operate. So that's what we're seeing. We're seeing E, S, and G. A G is a given. You don't begin unless there's the G. But then if you find an organization that really understands the S really well, especially in an EM, it really counts. And then if they understand the E, so they're not polluting, given all these emerging markets are now introducing regulation, then it's even lower risk. So all 3 have become a critical factor of risk management, not just doing good, but risk management.
And Stergios, I see you nodding your head. I'd also like your perspective, because prior to ALTNOVEL, you were obviously the CIO or CEO for one of the largest family offices in the region as well, which I know has always prided itself on placing quite a lot of emphasis on impact. So I would love both sides of the equation there, your perspectives.
Again, I will agree with Ketan that financial services companies with a long-term perspective, impact for them is part of their philosophy and their culture. So that's one thing. Now, in terms of family offices, of private investors, all of us, when we want to invest with a long-term perspective, we're looking at impact. And financial returns are there, but also what we're looking at is non-concessionary returns. We're looking at generating the returns that you are expecting to have across different asset classes. It's all about risk and return. But how can you measure the impact? How can you contribute? Is knowing, is be more aware, and that will drive. I hope in 5 years from now we will not have this panel, right? Because to me, impact is embedded into investing philosophy. And the young generations of the families that we are working with and interacting, they're always asking, so how can we make impact? How can we do something more than making money? And that's where we need to be specific and clear on different areas of investing, asset classes. I mean, to me, venture capital that is right now suffering by the lack of fundraising through this correction is a fundamental asset class for impact. Because if we don't have venture capital, it's just, the private money staying in banks, generating the 5-6%, which is great, but it's not being put to work. So we need to analyze more all of these things, and that's where, as a firm, we want to, it's a key aspect of how we want to do business and allocate capital into funds, but also into new strategies, maybe. And the innovation aspect comes on when we see a problem, how can we create a solution? Like, we're looking at that now for the venture capital because it's a bit broken, and we need to fix this.
Well, that will actually be a great segue later because there is a panel on shifting trends in venture. But sorry, I saw Ketan.
I was going to build off that and just add a point, which is if you take the macro and you start to look at an EM, I think it was always difficult to follow the Chinese model of how they built their economy. For any other EM, it was almost impossible. No one had the levers. But if you look at what India is now doing, you start to see a model for other EM. So lots of things, of course, go wrong with that model, but the things that go right are if the government policy is driven towards mass inclusion of the population, then actually that's a big tick. If it strengthens the rule of law, that's a big tick. If it makes it more easy to implement that rule of law, it's a big tick. If it introduces a regulatory ESG policy so that risk management is built into the model, not because they want to overcomplicate the reporting, but because they actually want to see risk built in, then that's a big tick too. And you saw the Indian government do all of that, but it began with a financial inclusion drive where they used a piece of technology, which was an ID system, to generate a bank account. So what it meant was a poor individual, any individual, could turn up in a small shack, put a thumbprint down, answer a few questions, and in 3 minutes, a bank account would open for them. 500 million bank accounts have been opened in India in the last 8 years. So the underpinning of the growth of the country is mass financial inclusion. So with this bank account, you get a soft loan from the government, you get a debit card, credit card, savings account, an insurance policy for critical accident, a critical healthcare policy too. Now, all of a sudden, you're a player, and it explains why the GDP of India is growing so fast, and why the latest Morgan Stanley report on this, and there was one by Goldman before, the IMF before that, says by 2030 they expect India to be the third biggest economy in the world. Now, it's driven off the idea of mass inclusion, which says we're not wasting this population has to participate. And that participation first is financial, then it's educational, it's healthcare, it's tech, and it keeps going. And I think there's a model there that others can replicate. We work with the Indian government to see if they would transfer this technology for free to the rest of the world. And I was delighted in May at the UN, they announced that they would do that. So it's, I think that drive for inclusion is one of the drivers of profit also for investors.
That's brilliant, and congratulations. I mean, to have that approved in May is really quite fantastic. And I'd like to touch on a bit, we have not that long left, but I would like to touch upon some of the differences that we're seeing for impact across the different asset classes. And Tarik, I think you're probably best positioned to answer this, given that you look across so many. What are you seeing on both the GP side, but also from your your side in terms of your analysis.
Yeah, sure. So if I may add on the, what we talked about, our ESG approach, but we also do invest in thematic sustainable investments, like the energy transition that, many Canadian portfolios and pensions have as well. And also technology, the panel touched on that multiple times. So looking at technology, how it's really infusing traditional asset classes and, the built world, finding solutions like the prop techs, the climate techs, infra tech, just touching different asset classes. That's something we're really big about as well. Something else which is unique and on the private debt side, just talk about litigation finance, not correlated to financial markets, right? You can get 15+%. In Colombia, emerging market, we compare it to the public bond in US dollar terms, which is 3 to 4%. But when you go to the private debt in Colombia, where you buy claims from families who got hurt by the government, if their police officer got, killed, the main provider or the army, the government actually pays the money, but they have to wait for a couple of years. So we come in, buy the claim, and we help the people, and we get paid afterwards, and just wait that long-term play. So just a kind of a social impact as well. So we have multiple of these across the portfolio. But just to answer your question quickly, if we touch on the public markets, hedge funds, it's very trading oriented, right? It's all about P&L with hedge fund managers. And it's really dependent on the strategy. If it's equity long short, it's public data, it's easily available, you can benchmark it, so it's easy to follow an ESG process. On the credit, you can find it as well, but less so on managers like trading the derivatives macro. It's much more challenging. There's no standard measure yet. Do you look at it from the top at the level 1 or underlying asset that is trading on the delta side? On the private side, just quickly, if we look at real estate and real assets, 40% of the emissions, I believe, are coming from real assets. If you take in consideration the energy used to operate the building and also the materials, the construction material, which is massive. So it's really important for us to focus on making these buildings transition risk, we call it, by making it more greener. And also on the physical side, these are hard assets from climate risk and change. So focusing on these two risks with the underlying infrastructure and real estate manager. So they score higher on the ESG for us. And then on the VC side, it's the least amount of data, to be honest. It's harder because they're also about return. They're building companies from the ground up. They score lower, but they're much more open to work with us. And the big player is the size of the GP. So we break down 3 sizes, right? 10 billion plus. Our ESG score is actually in 4 buckets, just really quickly. I'm looking at the time here. We have developing. They actually not present. They have nothing about ESG. Developing, right? And then intermediate and advanced. It's very simple, 4 buckets. The VC side is always developing, but on the prop tech, the infra tech we talked about, they're more intermediate to advanced in terms of ESG because there's no ESG impact focus to their strategy. And then on the sizing, just going back, 10 billion plus, they're intermediate advanced. The mid-level managers, they're more in the developing to intermediate. The smaller, developing and not present. So that's the bucketing, and real estate tends to be on the right side more, hedge funds on the lower side, low score, VC in the middle, PE depends on the sector, I would say to middle to advanced, and the size is about everything. The lower manager has smaller dedicated resources on the ESG side.
So there are so many follow-up questions I want to ask on that, but we have less than 2 minutes left, and my full-time job today has been sitting there staring at people that have been going over time. So I will just ask one more question, which is, what do you think that asset allocators need to do more of to move the needle forward on impact? And I'd like input from everyone. Maybe start with Stergios.
Maybe in terms of the criteria, how you select fund managers and the underlying strategies, how they invest in companies, how they look at. The ESG is just a framework and a scoring at the end of the day, right? How we rate fund managers and companies, and we need it. But impact investing, to me, the way I perceive it is every dollar we invest, what is the real impact out of it, right? So we need to see what are the methodologies on fund managers on this, their analytics, how advanced they're getting there. And we want to work more on this. And last point is that this is very developed in the Western markets, in the US and Europe for now, but we need to bring it here. And there is a statistic from GDIN that 92% of AUM impact AUM, however we classify it, is managed by US and Europe for developed markets. So we need more in emerging markets, both on fund management and allocating into companies and projects.
Ketan.
So I would love it if allocators looked at all three dimensions. They looked for risk, return, and impact, and it was part of their standard model. I think Bridgewater, as you began, is a good example of somebody who's figured that out. And I think if you start to look at all three, you start to build a much more sophisticated base that is suited to where the world trend line is going in terms of the need to raise the south of the world too. And it's much more profitable that way too, I think.
For me, just lastly, it's really to engage with the GP-LP relationship, make it, collaborative, working together, and it's all about data as well. So being transparent with the LP, even if you're not sophisticated in ESG, nobody has the perfect measure, just to work together, thinking about a risk-adjusted basis, like the panel is saying, and impact-adjusted basis. So something that we're looking to do in terms of measurements, how we can calculate that.
Well, Stergios, Ketan, and Tarik, thank you so much for covering such a broad topic in a short space of time. Really enjoyed the conversation. Please thank my fellow panelists.
Thank you. Thank you.